There is a specific type of financial loss that never shows up as a transaction. It doesn't appear as a charge on your statement. No alert goes to your phone. No balance drops. You will never receive a notification that says you lost money this year by not doing anything. But the loss happened. It happens every year. And for most people, it has been happening quietly, invisibly, for a very long time. Most people scan their finances looking for the wrong thing. They look for spending, charges, purchases they regret. But the losses I'm talking about today aren't what you spent. They're what you failed to do. Accounts you never switched, bills you never questioned, services you never reviewed. And the total cost of all that inaction, spread across a year, is something most people have never actually calculated. My name is Ted. If you haven't done a full financial audit in the last 12 months, what I'm about to show you will make you want to open 3 browser tabs before this video is over. Hit subscribe and give this a thumbs up. Let's get into it. Okay, first, let's talk about why financial inertia is so hard to notice. Because it's not laziness. It's not irresponsibility. It's actually something your brain was designed to do. Here's the thing. The human brain has a deeply wired preference for the current state of things. Behavioral economists call it status quo bias. Whatever is already in place feels safe, familiar, and acceptable, even when something better is available. Changing banks feels like a project. Calling your insurance company feels like an argument waiting to happen. Canceling a subscription feels minor enough to deal with later, and later never comes. So the default stays. The inaction continues, and the cost accumulates. The reason this matters financially is that the companies you do business with understand this better than you do. They build their entire retention model around it. They know that most customers will never call to renegotiate. They know the average person hasn't reviewed their subscriptions in over a year. They know the checking account you opened at 22 is probably still the one you're using at 35. And they price their products accordingly. Inertia isn't just a personal habit. It's a revenue stream. For them. Let's look at the math, and let's look at 3 specific places where financial inertia is most expensive. The first is your savings account. The average traditional bank savings account in the United States currently pays around 0.01% interest annually. That means if you have $10,000 sitting in a standard savings account, you earn approximately $1 per year in interest. $1. Meanwhile, high-yield savings accounts, offered by many online banks, fully FDIC insured, zero risk, are currently paying between 4% and 5% annually. On that same $10,000, that's $400 to $500 per year. The difference in effort between those 2 outcomes is 1 afternoon and 1 online application. The difference in annual return is roughly $499. The account you haven't switched is costing you that gap every single year you stay. Now compare that to someone who moved their savings to a high-yield account 3 years ago. Over those 3 years, at 4.5% on $10,000, they've collected roughly $1,400 in interest. The person who didn't switch collected about $3. Same money, same risk level, completely different outcome, driven entirely by one decision that took less than an hour to make. The second is your subscription stack. Studies consistently show that the average person underestimates their monthly subscription spending by about 2.5 times. People guess they spend around $80 a month on subscriptions. The actual average is closer to $200. And the gap between those 2 numbers isn't fraud. It's forgotten services, trials that converted to paid plans, streaming platforms added during a specific show and never canceled. Apps purchased once and renewed automatically ever since. Premium tiers for tools used occasionally that a free tier would cover just fine. Here's what most people don't realize. Subscription businesses are deliberately designed around the path of least resistance. Getting in is 1 click. Getting out requires finding the cancellation page, confirming through multiple screens, and sometimes calling a number. The friction is intentional, and it works. The average person is paying for at least 2 to 3 services they have either forgotten about entirely or no longer use regularly. At an average of $15 to $20 per forgotten subscription, that's $30 to $60 a month, $360 to $720 a year. leaving your account so quietly you've never noticed it on a statement. The third is your recurring bills. And this one is where most people leave the largest amount on the table. Car insurance, home insurance, internet service, phone plans. These are all industries built on what's called the loyalty penalty. The longer you stay with a provider without questioning your rate, the more you tend to overpay relative to what a new customer would be offered for the same coverage or service. Insurance companies in particular are well documented for this. A study by the Consumer Federation of America found that loyal customers who never shop around pay significantly more than new customers for identical policies. The company isn't rewarding your loyalty. They're charging you for your inertia. Let me give you a simple way to think about the whole thing. Imagine you own a rental property and you have 3 tenants. One is paying below market rate on a lease you signed 5 years ago and never revised. One is a tenant you forgot you had. They've been quietly sending rent to an old account. You check maybe twice a year. And the third is paying a premium because they negotiated badly when they moved in and assumed the rate was fixed. You're the landlord, but in this scenario, you're also somehow all 3 tenants at once. The money leaving your accounts in all 3 of these categories is your money. It's just being managed by default instead of by decision. Here's the insight most people miss. Financial inertia doesn't feel like a choice. It feels like a non-event. Nothing happened today. Nothing went wrong. But the cost of inaction compounds just as reliably as the benefit of action. Every month the savings account stays unswitched is another month of near zero interest. Every month the forgotten subscription renews is another month of paying for nothing. Every year, the insurance policy auto-renews without a rate check is another year of the loyalty penalty. Here's what it comes down to. The financial losses from inertia are not dramatic. They don't arrive as a single painful event you can point to and learn from. They arrive as a slow, invisible drain, small enough to ignore in any given month, significant enough to matter enormously across a year or a decade. And the fix is not complicated. It's just a scheduled decision to review what you've been leaving on autopilot. So if you want to actually recover what inertia has been taking from you, here's the realistic approach. First, do a single afternoon savings account audit. Find your current interest rate. Search for the top FDIC-insured high-yield savings accounts available right now. If the gap is significant, and it almost certainly is, open the new account and transfer. This is not a complex financial move. It is a form and a transfer. The return is immediate and ongoing. Second, run a full subscription audit. Pull up your last 2 months of bank and credit card statements. Highlight every recurring charge. For each one, ask 2 questions. Do I use this regularly, and would I sign up for it today at this price? If the answer to either is no, cancel it. Not later. During the audit, the friction is intentional. Push through it anyway. Third, shop your recurring bills once a year. Set a reminder every 12 months. Get competing quotes on your car insurance, home insurance, and internet service. Call your current provider with the competing rate. Most of the time, they will match it or come close because losing you costs more than reducing your rate. And if they won't, the competing offer is right there. The loyalty penalty only survives if you never check. 1 phone call per year per service is typically all it takes to eliminate it. Because here's the truth most people figure out too late. You don't have to make a single bad financial decision to lose thousands of dollars a year. You just have to leave things the way they are. The most expensive financial habit most people have isn't overspending. It's under-reviewing. And the cost of that habit is invisible right up until you calculate it. The losses were never on your statement, but now you know exactly where to look. If this made you want to open your bank statement right now, hit subscribe and leave a thumbs up. And I want to know, when was the last time you actually reviewed all your recurring charges? Drop it in the comments, because most people can't remember. And that's exactly the problem. Thanks for watching. See you in the next one.